Bitcoin is back in the spotlight, and the market is sending two messages at the same time. On one side, Bitcoin moved above $69,000 during the latest rebound, while U.S. spot Bitcoin ETFs recorded more than $517 million in net inflows on August 19th. That was reported as the strongest daily inflow since May 4th. On the other side, the U.S. crypto market still faces regulatory uncertainty. The Clarity Act is being discussed as a possible framework for digital asset market structure, but the Senate vote is not guaranteed, and current reports point to a procedural vote in September. So is this the start of a new crypto cycle, or just another short-term rally? In this video, we will explain ETF inflows, the Clarity Act, macro risk, taxes, custody, and 5 questions to ask before you buy, hold, or sell crypto. This is general education, not personalized investment or tax advice. A spot Bitcoin ETF gives investors exposure through a traditional brokerage account instead of requiring them to manage a crypto wallet directly. When these funds receive net inflows, the fund structure generally needs to buy or hold additional Bitcoin exposure. That can create a visible demand signal, especially when several funds receive money on the same day. But one strong inflow day is not the same as a permanent trend. ETF flows can reverse. Price can rise before flows arrive, or flows can follow a price move. The useful question is whether demand continues across weeks and whether the market can absorb selling from miners, traders, and large holders. Also remember that an ETF removes some custody friction, but it does not remove Bitcoin's price volatility. You can lose money even when the fund is regulated and easy to trade. The Clarity Act is designed to clarify how U.S. regulators divide responsibility for different digital assets and market participants. The basic debate is about which assets and activities belong under the Securities and Exchange Commission, which belong under the Commodity Futures Trading Commission, and what rules apply to exchanges, brokers, stablecoins, custody, and token projects. Supporters argue that clearer rules could encourage responsible institutional participation and give businesses a path to operate in the United States. Critics worry that the details could favor large centralized companies, create compliance costs, or leave parts of decentralized finance uncertain. The important point for investors is that a bill is not a law. A hearing, a committee vote, or headline does not guarantee final passage. The timeline, amendments, vote count, and final text still matter. Bitcoin is often treated as the most established crypto asset, but that does not make it a low-risk asset. Ethereum has a different technology, different use cases, and different questions around staking and network economics. Smaller tokens can carry additional risks, including lower liquidity, concentrated ownership, smart contract vulnerabilities, and regulatory uncertainty. A crypto ETF can also have different risks from holding an asset directly. Compare fees, tracking, custody arrangements, trading hours, tax documents, and whether the product actually holds the underlying asset or uses another structure. Do not treat the word crypto as if it describes one investment. Crypto also responds to the broader price of money. If inflation, treasury yields, or geopolitical uncertainty push interest rates higher, investors may reduce exposure to volatile assets. If liquidity improves and yields fall, risk appetite can return. That relationship is not mechanical, but it is important. The IRS treats digital assets as taxable property for federal tax purposes in many common situations. Selling, exchanging, or using digital assets can create a reportable gain or loss. Rewards, payments, airdrops, and other transactions can have different tax treatment. Some brokers may issue Form 1099-DA, but the absence of a form does not automatically mean a transaction is ignored. Keep records of dates, units, purchase cost, sale proceeds, fees, transfers, and wallet activity. Do not wait until tax season to discover that several platforms used different cost basis records. For your situation, use current IRS guidance or ask a qualified tax professional. Now ask 5 questions before you buy. First, what is the role of this position in your portfolio? Is it a small speculative allocation, a long-term high-risk investment, or money you may need soon? If the answer is unclear, the position may be too large. Second, am I buying the asset, an ETF, or a company connected to crypto? Bitcoin, an ETF, an exchange stock, and a mining company have different business and market risks. Third, What happens if the regulatory bill is delayed or fails? A legal catalyst can support sentiment, but it cannot guarantee price appreciation. Build a plan that survives both outcomes. Fourth, can I handle a large drawdown without selling in panic? Crypto has experienced sharp declines before. Your position size should reflect that reality. Fifth, do I have a record-keeping and custody plan? A trade is not complete until you understand where the asset is held, how it is secured, and how the transaction will be reported. Do not make Bitcoin your emergency fund. Do not borrow to buy a volatile asset. Do not put rent, tuition, or near-term medical money into a speculative position. If you already have a diversified plan, use a position limit and rebalance instead of chasing every headline. If you are new, learn how wallets, exchanges, ETFs, fees, taxes, and market orders work before you buy. A rising price can create confidence, but confidence is not risk management. Bitcoin's latest move has a real catalyst: stronger ETF flows, a regulatory headline, and improved risk appetite. It also has real risks: price volatility, legislative uncertainty, macro pressure, custody, taxes, and the possibility that inflows slow down. The question is not, will Bitcoin go up? The better question is, what am I owning, why am I owning it, and how much loss can I handle? Subscribe for data-driven U.S. finance videos. Comment BTC if you want a beginner crypto risk checklist next. This video is general education, not individualized investment, tax, legal, or financial advice.